All right, welcome to The Explainer. Today, we're going to tackle a really fascinating puzzle from the world of corporate finance. Why on earth would a company, after spending millions to go public, suddenly want to just disappear? I mean, it seems totally backwards, doesn't it? Companies fight tooth and nail for years to get that prize spot on a stock exchange. So why would they turn around and do the complete opposite? Well, as you'll see, sometimes the smartest move a company can make is to shrink its public presence or even walk away from the market altogether. So this brings us to two very different strategies a company can use. On one hand, you've got delisting. You can think of this as taking the company home from the big public party. The owners buy back all the shares and go private again. On the other hand, there's the share buyback. Here, the company stays public, but it uses its cash to buy its own stock, which makes the remaining slices of the corporate pie that much bigger for everyone else. Okay, so let's dig into that first path, going private. This is a massive step. It usually tells you the company wants to make some really big long-term changes, and they want to do it far away from the pressure of Wall Street's quarterly reports. So how do they actually pull it off? This is what's called a voluntary delisting. The idea is pretty simple, really. The company's main owners, we often call them promoters, make an offer to buy out all the other shareholders. Their goal is to get back total control and run the business without having to answer to the public every 3 months. Now here's where it gets really interesting, especially in a regulated market like India. It's not as simple as the owners just picking a price. No way. Take a look at step 3, reverse book building. This is a super unique process. It's basically an auction, but in reverse. The big institutional shareholders bid the price at which they're willing to sell their shares. It's a clever, market-driven way to find a fair price that protects the smaller investors. And this right here, this is the magic number, 90%. It's the biggest hurdle of the entire process, for sure. The promoters have to convince enough shareholders to sell so that their total ownership hits that 90% mark. If they only get to, say, 89.9%, the whole deal is off. It fails. This actually gives a ton of power to the minority shareholders, because if they feel the offer is too low, they can just hold on and block the whole thing. All right, so that's delisting. Now let's switch gears and talk about the second path, which is honestly way more common and something you see in the news all the time. The share buyback. This isn't about disappearing. It's about using the company's own profits to reward the people who stick around. So why do this? Why buy your own stock? Well, first, if you're a company flush with cash but you've run out of big new projects to invest in, it's a great way to return that money to the owners. It also has a nice effect on the numbers. By reducing the number of shares, your earnings per share, or EPS, automatically goes up. But maybe the biggest reason is the signal it sends. Management is basically shouting from the rooftops, "We think our own stock is the best investment we can make right now." And just to give you an idea of the sheer scale we're talking about, look at this number. The Indian IT giant TCS, Tata Consultancy Services, spent a mind-boggling 18,000 crore rupees. That's over $2 billion on just one buyback program. So how'd they do it? They used what's called a tender offer. Basically, they made a public announcement saying, "Hey, shareholders, we want to buy back our stock, and we'll pay you a fixed price for it," which, by the way, was a nice 7 to 10% higher than the market price. It's a very direct, very quick way to put cash straight into investors' hands. And that's a really important distinction to get. That tender offer is a big, splashy, one-time event. Here's the premium price, sell to us now. The other method is an open market buyback. This is a much slower, steadier approach. The company just goes into the stock market over many months and buys its shares gradually, just like any other investor. It doesn't offer that instant pop, but it can act as a nice, steady source of support for the stock price. Okay, so now you know the mechanics. What's the so what? What does this mean for you as an investor? And how can you possibly get ahead of the curve and spot these situations before they make headlines?
If you're looking for a potential delisting, you've got to put on your detective hat. The number one clue? Look at the promoter's shareholding. If it's already high, say over 75%, and you notice they're still slowly buying up more stock, that's a huge tell. Combine that with a solid company whose stock price just seems stuck in the mud, and you might have the perfect recipe for a delisting attempt.
For buybacks, the playbook is a bit different. Here, you're hunting for cash cows, companies that are just gushing cash with huge reserves, but maybe not a lot of exciting new places to put that money. If their stock looks a little cheap and management has a track record of being good to its shareholders, a big buyback could very well be on the horizon.
But, and this is a huge but, before you get too excited, you absolutely have to understand that these are not risk-free bets. Not at all. There are some very real risks and red flags to be aware of.
The number one risk in all of this, especially with a delisting, is brutally simple. It's execution risk. The whole deal might just fall apart. For a delisting, what if they don't hit that 90% threshold? The offer fails and the stock price can take a serious nosedive. In a buyback, what if that tender offer is super popular? Well, they might only accept a small fraction of the shares you offer, leaving you holding the rest. And then there's that bigger, more philosophical risk. Is a huge buyback a sign of supreme confidence, or is it a quiet admission that the company is all out of growth ideas?
And that really leaves us with the big question to chew on, doesn't it? When a company starts buying up its own stock, is that the ultimate vote of confidence? Or is it a subtle signal that its best growth days are now in the rearview mirror? It's something to think about, because the next time you see a buyback or a delisting in the news, you'll know it's not just some boring financial transaction. It's a fundamental statement about a company's past, its present, and its big bet on the future. Thanks for joining this explainer.